Hello, my name is Jordan Suppan. I work with Leste Credit. Leste is an alternative investment manager. We manage approximately $2 billion in AUM spread across 5 different business units. I work on the real estate business unit, which manages approximately $1 billion in AUM on the credit team. We have offices in Sao Paulo, Rio, Miami, New York, and London, and our headquarters is here in Miami. Here at Leste Credit, we focus on continental U.S. So all of our lending products is 100% U.S. real estate focused. We are majorly focused on the Southeast United States, states that have positive net migration patterns and affordability. So I would say what we would call the Smile States or Southeast United States, ex-California. That's our predominant geographic focus where we're seeing the most opportunity. Sure, I would say that it's an interesting market. In general, the lending market has become a lot more tight, right? There's significantly less liquidity on the streets and then significantly less liquidity within the construction financing space. So you've seen a significant pullback from banks across the board, but it's particularly acute in construction financing. So it's an interesting time to be able to deploy dollars. You're deploying dollars at a significantly lower attachment point and higher yields. And it's not just higher yields, it's also wider spreads. Conversely, I would say that, interestingly enough, where multifamily lending on the construction side or value add side or multifamily in general was fairly prolific prior to this interest rate volatility, I would say the most difficult projects to get construction financing for now are multifamily ground up. And I think there is a plethora of reasons why that is. I think you still have more appetite for industrial, triple net lease, other asset classes where there's less concern about cap rates and sort of where the yield on cost needs to be, or other ones where the rental numbers, there's less volatility in what people think that the rents would look like going forward to underwrite that NOI. So a big thing that we've been exploring is the relative value between whole loan lending and what is available in the public market. So you still see a fairly, I would say, like a value trade between what you can buy in a public security versus what you can lend at today in the whole loan format. Up until I would say, the recent numbers, there was an expectations that things were stabilizing, but with the recent run up in the 10-year again, there's a continued ambiguity around what is going to happen, right? So as the 10-year changes and inflation expectations changes, it puts a lot of pressure on what new projects are going to be able to cash flow at, given the debt service coverage ratio constraints. So when that moves, when the longer end of the curve moves around 45 to 50 basis points, it makes it very difficult for people to understand where their takeout financing is going to be. Yeah, I guess what I would, as a journalist or as in the market, I think what I'd be interested in understanding is structural themes, right? What's changing? So I think one of the main structural themes is residential real estate in the United States, right? So you have this supply-demand imbalance where you don't have a lot of supply. You do have demand. There's been some demand destruction in terms of people not being able to afford mortgage payments. and so therefore are staying as renters. But it's really it's an affordability issue, right? So you have a geographical migration to states where affordability is better. So you have people moving from New York and California to states like Austin and Florida, and then you have people moving from Florida to, say, the Carolinas. So I think that on the residential side, finding opportunities to lend into markets where they have positive net migration patterns, good employment, and affordable housing. I think one of the main things that people need to focus on financing, both as an investment strategy, but just in general, is that the US lacks affordable housing. And so you've got a supply demand imbalance in general, but it's particularly acute within the affordable space. So I love to lend on specifically within the construction space. I feel very comfortable lending on single family residential construction where the end product is, say, a house under $500,000 in a market that has good employment and good growth from an employment standpoint. So you're seeing a lot of people that with remote work are able to move to the Carolinas, buy a $350,000 home, whereas the average price of a house in Seattle is like $790,000, right? Which is difficult for people. And obviously wages haven't kept up with the increase in prices or the increase in rates. So that overall mortgage payment is really important. Just the other major theme is that the Fed took a fairly heavy hand in bank regulation, so that the capital ratios that banks were having to hold increased a lot. So there's just been the banks have almost exited the construction lending market very quickly, and so that's left a lot of alternate lenders opportunities to finance good projects, albeit at lower proceeds.